The quiet of a Sunday evening was shattered by a single, staggering number. On the electronic trading platform known as Globex, the after-hours pulse of the futures market, the price of silver did not climb. It did not rally. It erupted. In a flash of digital energy, it traded at $106.55. This was not a continuation of a trend. It was a market seizure, a violent upwards dislocation that in its sheer abrupt force signals a deep and fundamental fracture in a system many assume is stable and liquid. For decades, the price of silver has been dictated by a complex paper-driven mechanism. But what if that mechanism is breaking? What if the smooth, liquid facade is cracking under the weight of a physical reality it can no longer contain? This is the story of that crack. It is a forensic examination of a hidden imbalance, a tale of two separate worlds, one of digital promises, the other of tangible metal, and the moment the tension between them snapped into public view. To comprehend the significance of that fleeting print at $106, we must first understand the official action. The official price of silver, the number quoted on financial news networks and used as a reference in contracts worldwide, is set on the futures exchanges, primarily the COMEX operated by the CME Group in New York. This is the established, sanctioned arena. It is a market built not just on silver, but on contracts, legal agreements to buy or sell a specific amount of silver at a predetermined price on a future date. The critical nuance, the linchpin of the entire modern pricing scheme, is that the overwhelming majority of these contracts are never intended to result in the physical movement of metal. They are financial instruments. They are used by algorithmic traders, by hedge funds placing speculative bets, by institutions hedging other risks, and by market makers providing liquidity. The system operates on a foundation of trust and cash settlement. The trust that a counterparty will honor its financial obligation, and the expectation that obligations will be settled in dollars, not in delivery trucks pulling up to a vault. This creates a market of immense scale. On any given day, the volume of paper silver traded can represent many multiples of the entire world's annual mine production. This vast ocean of paper creates liquidity, the feeling of a deep and always accessible market. It allows for the smooth entry and exit of large positions, or so it seems. It establishes the COMEX price as the global benchmark, the North Star for miners, jewelers, industrial users, and investors alike. The Sunday night explosion on Globex is a direct challenge to this orderly paper-based paradigm. Globex is the electronic outpost, the trading that continues when the main floor is dark. It operates with a skeleton crew of global participants. Liquidity is thin. The usual crowd of market makers and high-frequency traders is diminished. In this environment, large orders are not easily absorbed. They echo. The spike to $106 is that echo, amplified to a deafening roar. It tells us one incontrovertible fact. At the precise moment that buy order entered the system, there were not enough willing sellers, not enough entities willing to take the opposite side of that trade at the previous price. The market had to gap, to leap violently higher, to find a level where someone, anyone, was willing to provide that liquidity. This is abnormal. In a deep, healthy, and fundamentally balanced market, such gaps are rare and quickly filled. This was a rupture. It suggests the normal suppliers of liquidity, the institutions that typically stand ready to buy and sell, were either absent or, more importantly, unwilling to sell at what they may have perceived as an unsustainably low price, even at levels near multi-year highs. This matters because the official price is the bedrock. If that bedrock can fracture so easily in thin trading, it calls into question its stability under true stress. It reveals the paper market not as a perfect mirror of reality, but as a potentially fragile construct. The $106 spike is a signal flare, illuminating a profound and growing disconnect. It is the first, loudest clue that the world of paper promises and the world of physical metal are no longer moving in sync. This brings us to the core divergence, the central tension of this entire narrative. The paper market and the physical market are increasingly two different universes, sharing only a name. The paper market is a realm of digits on a screen, of balance sheet entries, and of cash flows. Its defining characteristic is its seemingly infinite scalability. With a keystroke, a trader can sell 1 million ounces they do not have, betting the price will fall before they have to close the position. This action creates sell-side pressure that is entirely financial, divorced from the logistics of metal. The physical market, in stark contrast, is a world of weight, of logistics, and of finite supply. It is the world where a solar panel manufacturer needs silver paste for their production line next month. It is the world of an electronics firm sourcing conductive inks, of a mint stamping coins, of a refinery processing doré bars from a mine. Here you cannot create a bar of silver with a keyboard. You must source the ore, dig it from the ground, process it, refine it, assay it, and transport it. This process is slow, capital intensive, and constrained. For years, The signals from this physical world have been flashing warning signs, while the paper market often seemed to look the other way. The most persistent signal is the premium. When you walk into a coin shop or order from an online bullion dealer, the price you pay is not the COMEX spot price. It is the spot price plus a premium. This premium covers fabrication, distribution, and dealer margin. In a balanced market, it is relatively stable. For years now, that premium has been elevated and stubborn. It is common to see physical silver coins and bars trading for $4, $6, or even $8 over the reported paper spot. This is not a minor detail. It is a direct market price signal, shouting that the actual metal, in the form that people want to hold and use, commands a materially higher price in the real world than its paper representation does on an exchange screen. This is the first major crack in the narrative of a single unified price. The second signal is time. Delivery times for popular retail items have often stretched from days to weeks. This indicates supply chain strain, a bottleneck where demand for finished, investable form factors is pressing against refining and minting capacity. The physical market has been whispering, then speaking, then yelling a clear message. There is a shortage of metal in the forms that end users demand. The paper market, with its boundless digital inventory, has for long periods seemed to ignore this shouting from the tangible world. The Sunday night explosion to $106 may be the moment the paper market was briefly forced to listen. It was a glimpse of the physical market's urgent, desperate energy violently intruding into the digital realm. When a buyer on that thin electronic platform was willing to bid $106 for a futures contract, it may have represented a hedge against a terrifying possibility: the inability to source physical metal at any price tomorrow. The two pricing mechanisms are built on different foundations. Their growing separation is not a minor technicality. It is the central fault line in this market. To understand the source of the pressure causing this fault line to slip, we must descend into the vaults. These are the secured depositories, the critical but often opaque link between the paper promise and the physical object. Within the COMEX system, silver held in these approved vaults is categorized in two crucial ways. Eligible silver is metal that meets exchange standards for purity and form and is stored in a licensed facility. It is in the system, but it is not necessarily for sale. It could belong to an ETF, a sovereign wealth fund, or a private investor simply using the secure storage. It is inventory, but not necessarily available inventory. Registered silver is the beating heart of the delivery mechanism. This is eligible metal that the owner has placed into the exchange's warrant system. By doing this, they declare it officially available for delivery to satisfy a futures contract. This registered inventory is the liquidity pool. It is the buffer stock that backs the promise that the paper market can, if demanded, deliver the real thing. The trend in this registered category is the most critical and arguably the most alarming data set in the entire silver equation. Over a period of years, this buffer has undergone a sustained and dramatic erosion. From historical levels measured in the hundreds of millions of ounces, it has dwindled to a level now measured in the tens of millions. It has at times flirted with lows not seen in decades. This is a straightforward depletion. The stockpile of metal explicitly earmarked to back the system's paper promises is shrinking. Concurrently, the open interest, the total number of outstanding futures contracts, each representing a promise to buy or sell, remains elevated. This creates a simple mathematical relationship: the ounces of deliverable metal versus the paper claims on those ounces. When this ratio becomes thin, the system's resilience vanishes. It suggests that if a meaningful percentage of those paper contract holders decided to switch from cash settlement to demanding actual delivery, the logistical machinery would be overwhelmed. There would not be enough registered metal to go around. This is not speculation, it is arithmetic. The vault data is the balance sheet of the paper market's physical credibility. A declining registered inventory, especially during a period of reported price discovery, indicates a net movement of metal out of the financial system and into the hands of entities that do not intend to lend it back. It is going into industrial products, into strategic national stockpiles, and into the strong hands of investors who simply want to own it, period. Every ounce that leaves the registered category makes the paper market more of a bluff. The violent spike to $106 can be interpreted as a market spasm, a sudden reflexive lurch, acknowledging this tightening physical reality. When the deliverable supply is low, the market becomes a tinderbox. The Globex spike was the flash of the match. This leads us to the complex question of motive. Why would the large financial institutions at the center of this market operate in a way that allows such a precarious situation to develop? We must approach this neutrally, examining their roles as market participants, not as villains or heroes. These institutions, often called bullion banks, perform several functions. They act as market makers, providing the bid and ask prices that facilitate trading. They offer hedging services to mining companies who sell future production to lock in prices, a service that inherently involves the bank taking a short position. They also engage in proprietary trading, taking speculative positions based on their market views. In executing these roles, they collectively often hold a significant net short position in the silver futures market. A short position is a bet that the price will fall. From an operational standpoint, a portion of these shorts is indeed a natural byproduct of facilitating producer hedging. However, the sheer scale and concentration of these short positions have long been a point of analytical and regulatory scrutiny. The structural concern is that positions of this magnitude can, whether intentionally or simply through the mechanics of risk management, influence the very price discovery process they are meant to serve. If a small group of entities holds a dominant share of the short side of the market, their collective actions to manage their risk, covering shorts by buying or adding to shorts by selling, can create price movements that overwhelm other signals. Their primary motives are risk management and profit, governed by internal models and regulatory capital requirements. If they hold a large short book and the price rises sharply, they face mark-to-market losses. Their response is not unified, but a series of individual calculations. Some may judge the rise as unsustainable and add to shorts, attempting to cap the move. Others may see the physical data and decide to cut their exposure, buying back contracts to close shorts. This divergence of opinion among large players itself creates volatility. The historical record includes legal settlements where institutions have paid substantial fines for practices like spoofing, placing, and quickly canceling large orders to create false liquidity impressions, proving that regulators have identified and punished specific manipulative conduct in these markets. Therefore, in the wake of an event like the spike to $106, the institutional motive is not a monolithic conspiracy. It is a fractured landscape of risk assessments. Some desks may be forced to buy, fueling the move. Others may be mandated to sell, attempting to quell it. Their actions are driven by the cold calculus of balance sheet preservation in a market where the foundational data, the vault stocks, is telling a very different story from the price action they may have previously engineered or anticipated. Caught in the crossfire of this structural tension is the retail investor. Their experience is often one of profound psychological dissonance. They are presented with compelling, publicly available data. The annual supply deficits reported by the Silver Institute, the explosive growth of industrial demand from photovoltaics and electronics, the undeniable drawdown of exchange inventories. They act on this, entering the physical market, paying a significant premium over the reported spot price to acquire real metal. Then, they watch the paper price on their screens, the official benchmark, stagnate or even decline in the face of this bullish data. This creates a powerful sense of injustice and distrust. It feels like the system is ignoring reality. The emotional toll is real. They are told by mainstream commentary that their thesis is flawed, that they are misunderstanding the market, even as they struggle to find the actual product to purchase. They watch the value of their investment seemingly languish, challenged by a paper price that feels increasingly abstract. This psychological warfare leads to attrition. Many surrender, selling their metal out of frustration, often providing the very physical supply that alleviates momentary pressure in the system. Others become hardened, disconnecting entirely from the paper price and focusing solely on the accumulation of ounces, a philosophy of tangible value preservation. The spike to $106 is a moment of intense psychological resonance for this group. For a fleeting instant, the paper market screamed the same thing they have felt in their bones: urgency and scarcity. It was a moment of validation, but it is also a potential psychological trap. The immediate reaction can be euphoria or a fear of missing out, leading to impulsive decisions made at a moment of peak volatility. The retail mindset is the human element in this mechanical drama. Their collective behavior, whether driven by disciplined conviction or emotional capitulation, creates flows of both physical metal and paper contracts that the larger system must ultimately absorb. Their most powerful action, though rarely exercised en masse, is the decision to stand for delivery on a futures contract, to refuse cash and demand the metal. This is the ultimate check on the paper system, the action that forces the two separate worlds to collide directly. So where does this evidence lead us? We have a documented, multi-year structural deficit where demand consumes more silver than mine and scrap supply can provide. We have a paper pricing mechanism that exhibited a violent, destabilizing spike, a symptom of acute stress in low liquidity conditions. We have a physical market that consistently trades at a persistent premium, a clear signal of tangible scarcity. We have vault data showing the buffer stock meant to guarantee the paper system has been depleted to historically low levels. We have large financial institutions with conflicting risk mandates operating in this strained environment, and we have a global audience of participants experiencing the cognitive dissonance of it all. We cannot and will not offer advice, but we can outline plausible scenarios based on the interconnected facts. The first scenario is one of managed dissonance. The paper market, through its sheer scale and the continued actions of liquidity providers, successfully reasserts control. The spike is dismissed as an anomaly, a technical glitch in a thin market. Selling pressure returns, pushing the price back into a familiar range. The physical premium remains, acting as a permanent hidden surcharge for those who insist on real metal, while the paper benchmark continues its separate existence. The disconnect becomes a permanent feature held together by financial engineering and systemic inertia. A second scenario is gradual convergence. The fundamental pressure of the physical deficit becomes too insistent to ignore. Industrial buyers, facing genuine procurement challenges and supply chain fears, begin to use the paper market not for speculation, but for genuine securing of supply, bidding up futures contracts with the intent to take delivery. This steady, fundamental buying pressure slowly overcomes speculative selling, forcing the paper price to embark on a sustained climb, catching up to the realities of the physical market. This is a path of orderly but persistent revaluation. A third scenario is abrupt, violent convergence, a systemic snapback. This is what the $106 spike may have been a precursor to, a tiny tremor before a major seismic event. In this scenario, a catalyst, a geopolitical event that disrupts supply, a major sovereign announcement of strategic stockpiling, or simply a critical mass of delivery requests on the exchange, overwhelms the system. With registered inventories at critically low levels, the mechanism for physical settlement seizes. The result could be a forced short squeeze of historical magnitude. The paper price would detach from all prior anchors, surging vertically as those with delivery obligations scramble to find metal or buy back contracts at any price. This could lead to a chaotic but decisive moment where the paper and physical markets find a new, radically higher equilibrium, a price that truly rations the remaining available metal to only the most urgent needs. A final, more profound scenario is one of systemic irrelevance. If repeated events expose the paper benchmark as fundamentally broken or manipulable, trust in it evaporates. The global market for physical silver could fragment, with buyers and sellers negotiating directly based on physical benchmarks, regional premiums, and bilateral agreements, leaving the COMEX price as a relic, a ghost of a system that failed to bridge the gap between paper and reality. The print at $106 is a single, stark data point in an ongoing story. Its true significance is not in the number itself, but in what it reveals about the integrity of the structure beneath it. The evidence suggests the underpinnings are stressed. The rules of a past era of perceived abundance are being tested by the facts of present scarcity. The two worlds of silver, the digital and the tangible, cannot remain in perpetual divergence. Their eventual reconciliation, whether slow and grinding or sudden and explosive, will be dictated not by the paper promises but by the unyielding reality of physical weight and the finite number of ounces left in the vaults to fulfill them.